I'm Scarlet. This is Bloomberg ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. Escalating the price war. Charles Schwab shoots down the fee-based business model it helped build. It is moving to zero commissions on equity and ETF trading. Seeking return and stability, Kelly Yeh of Index IQ makes the case for an actively managed, high-yield, low-volatility fund. And China's Communist Party celebrates its 70th birthday. We explore a pair of ETFs that allow you to bet big on its fortune or failure. Love them or hate them, ETFs are here to stay, and their flows often signal broader market trends. So our ETF expert, Etf Balchunas, is here to show us what he sees in the latest flows.
Thank you, Scarlet. Last week we talked about a tug of war between bulls and bears. Kind of the same. Let's look at the leaderboard this week for the past week. Number one, let's just get this out of the way. This is BNDX. It's the Vanguard International Bond ETF. This, to me, isn't really a grassroots thing. It looks like a model portfolio trade going into it, probably Merrill. But that does show a little aggressiveness in the fixed income department, although BNDX still $8 billion for the year. A lot of people do like this one. It's fifth overall. But to me, here's where we get to the sentiment this week, which is low vol, right? Minimum volatility ETFs, quality. Then you've got the broad market and then some gold. That, again, talks about this cautious optimism that we're seeing when you go into equities and also the gold purchase. Let's look at the outflows here to see where people are coming out. Remember a couple weeks ago, Marianne Bartels was on and said that small cap rally is probably going to die? Well, she was right. Small caps are basically down worse than the S&P over the past couple of weeks. IWM seeing the outflows because of that. But look at elsewhere. That's short-term debt and that's short-term debt. So to me, this talks about a little bullishness. You wouldn't sell cash if you didn't have some optimism here. Now let's take a big step back and look at the third quarter, because that has ended, and just talk about the fixed income equity race that's been so interesting. Here's total ETF flows. Here's equity and fixed income. So you can see fixed income has been better in the first quarter, a little better in the second quarter, and almost tied, though, in the third quarter. So equity slowly chipping away at the lead. Right now, fixed income has a $40 billion lead, but that was as high as $60, $70 billion. So, Scarlet, if there's some bit of good news and we see some trading crowd reaction, we could have a photo finish between equity and fixed income. It's sort of heading that direction. And a potential regime change as well. All right, Eric, let's bring in Will McGough. He is CIO of Retirement at Stadion Money Management, as well as Carolina Wilson, who covers emerging markets for Bloomberg News. Will, let me start with you, because the recent data, the economic data, has renewed a lot of growth fears here in the U.S. Eric showed us how there isn't necessarily a lot of conviction for risk versus havens right now. What are you seeing?
Right, Eric. The flows tell all, because money drives price movements, and what we're seeing is gold, min-vol, bonds coming into favor. And I don't know if Q4 of last year has spooked investors or not, but that's certainly on their memory. Could it repeat this quarter?
Good points. Of course, Carolina, let's talk about China as well. There's a Bloomberg scoop that the White House is considering ways to limit U.S. portfolio flows into China. Obviously a big headline there, but what does it mean for EM ETFs?
So it's definitely interesting and important to digest what's at stake here for these U.S.-listed ETFs with Chinese stock exposure. And if we take a deeper dive and look at the numbers, there's about $550 billion in emerging market ETFs and mutual funds that are U.S.-listed. Now, with roughly about 20% of the exposure in those strategies to Chinese stocks, we're talking about the headline number over $100 billion of Chinese stock exposure in these U.S.-listed vehicles. And it's actually a pretty interesting week for the Chinese markets and for these China ETFs listed in the U.S. because the local market there is closed. And I love when there are instances like this, because I think it gives these single country ETFs sort of like center stage, or their time to shine, because they really do step in as price proxies. And even though we won't see the market makers sort of resume their normal roles of creations and redemptions, and we could see a dislocation between the price of these funds and its net asset value, it'll be interesting to see where those prices open and if it's in line with those ETFs. And the funds there to watch are MCHI, FXI, Asher.
Now, speaking of FXI, I went through your 13F, which I love doing. You own FXI. And we also shown some emerging market ETFs you own. You own about 4.
Right.
And they all have a good chunk of China.
Right.
How nervous are you? Do you see this as just hot air, or is this something you're really looking at and you might sell out of these?
Well, to put them into context of how we own them, it's in relative to the global equity portfolio. So China comes out to be about 3% of the global equities. So even though you're looking at just line item EM exposure here, it is a smaller percentage of our portfolio overall. And what you'll see is there's passive ETFs and then there's a multi-factor QEMM. So we take our EM exposure and roughly have half of it passive, where we're going to track the benchmark, and the other half is going to be an active multi-factor, which tries to reduce volatility. So it's one play to kind of quell the concerns you mentioned is through the multi-factor approach.
Interesting strategy there. Now, another big theme that we've really been following this week, Carolina, is the never-ending fee wars. Charles Schwab is getting rid of commissions on all U.S. equity and ETF trading. Feels like this was a long time coming. How are they going to make up for that?
So I think it'll be interesting to see what competitors do for this. But yesterday, so we saw shares of some of the largest online brokerages really take a hit, with Schwab unveiling these plans to eliminate commissions for U.S. stocks, ETFs, and options. And then after the market closed, TD Ameritrade comes out introducing zero commissions for ETF and options trading. So these are, like you said, Scarlet, the latest moves in this ETF fee war. And I think it'll be interesting to see, how long it takes competitors to sort of catch up to this.
And the hope, of course, is that they will add more customers as well, Eric. Schwab's move, a huge talking point for everyone on FinTwit, including you. Didn't you take a poll of everyone on asking how long it'll take before everyone follows suit?
Yeah, I did this last night at 8 p.m. because I have no life. Basically, the respondents were interesting. People generally see that Fidelity, which is the big enchilada here, we're curious what they're going to do. Are they going to go to zero? iShares has a deal with them where theirs are commission free. Will BlackRock step in and stop this? And it's really interesting. Will, what's your take, A, on the free trading and also Fidelity's, the prospects of them cutting to zero too?
Right, yeah. Fidelity was obviously the odd man out on y'all's chart of free ETF availability for trading. And it's just a general industry trend. Asset managers have gotten fee compressed thanks to Vanguard. And now this is, as you said, the Cat 5 hurricane coming through and taking it to custody and trading at the retail level, which is great. Now, the problem is going to be is what are advisors on Fidelity going to do if Fidelity does not react and do the same thing? There's going to be an interesting decision there. Do you go to where the trading is free, or do you stick with Fidelity and pay extra for presumably extra services that they offer? So it's going to be very interesting to see if and when Fidelity does react and how they react, mentioning that BlackRock deal that you talked about earlier.
What about the prospect of consolidation in the discount brokerage space? Talk about E-Trade having to team up with TD Ameritrade. What would that mean?
It would be interesting because E-Trade just bought the firm out of Denver. I'm drawing a blank on. To get into the RIA space themselves. And so if they pair it with an RIA-based aggregator like TD, it would be great for them. But they get a lot of their margin just like IB does from commissions, and these apps are killing them. Robinhood, Acorns, robo-advisors, it's all going to zero. So you got to make money somehow else.
And they're looking for ways. All right, Will McGough of Stadion Money Management, thank you so much, along with Bloomberg's Carolina Wilson. Now, coming up, we've got Chris Davis, Chairman and Portfolio Manager of Davis Advisors. We'll get his thoughts on the recent decision surrounding the ETF rule and how the shift to passive creates more opportunities for an active manager like him. And one ETF that caught our attention this week, the $2 billion iShares MSCI United Kingdom ETF, ticker EWU. It had its second biggest trading day ever. Investors were positioning as we get closer to this month's deadlines regarding Brexit. A reminder, you can find that chart and all the others we feature on Bloomberg at GTV Go. This is ETF IQ. I'm Scarlet Fu. This is ETF IQ. Let's take you through the ETF Lifecycle, which has three main stages. And step one is the filing. JP Morgan adds another fund to its suite of beta builder products by registering an international equity ETF. The fund will invest in developed markets around the world, but exclude North America. Step two is the launch. The Inspire International ESG ETF begins trading under the ticker WWJD. This marks Inspire's fifth fund. WWJD holds 150 international large caps that fit with Inspire's biblically responsible criteria. And for some, the final stage is liquidation. The Direction Daily High Yield Bear 2x shares is closing after more than 3 years. HYDD is a 2x daily leveraged ETF on the Bloomberg Barclays High Yield Very Liquid Index. It's time to get passive aggressive and explore the tensions between active and passive investing. Now, a stock picker who embraces the rise of index funds and ETFs is a rare breed. But Chris Davis of Davis Advisors says the shift to passive creates more opportunities for him. And he joins me in studio now. Great to see you, Chris.
It's good to be here, Scarlett.
So you're an active manager in an ETF world, which means you can be nimble, you can pivot quickly, you can respond to news when it happens. What kind of changes have you been making then?
Well, I think what tends to happen is when people are nervous, they go to where they feel safe. but often where they feel safe, they're actually taking more risk. So the way to think about it is, for example, when you think about flying after 9/11, people felt that they were taking a lot of risk. They felt safe before that. Afterwards, they felt it, but of course they were safer. They were just more aware of the risk they were taking. So where we're finding opportunity is usually in the areas where people feel risk, where they feel unsafe, and where we're seeing risk are in just those areas you were discussing earlier, things like the low volatility index, the areas where people feel safe. That's where the risk is. We're finding opportunity on the other side.
You're moving away from that. Now, active managers not shy at all about warning of the perils of passive investing. But let's be clear, because passive only owns about 17% of the equity market, and active managers, they need to talk their book as well. You've taken a different approach in that you welcome this overall shift to passive. You say it gives you more opportunities. How so?
Well, the first thing to recognize is that, there's a lot of mediocre active management, right? The average active manager has high fees. It's run by a portfolio manager with very little alignment of interest. They have high turnover. They, in a sense, are tracking their indexes, hugging their indexes. They aren't willing to look different. So there's a lot of mediocrity in the average active manager. And of course, passive has a lot of great strengths. It's low cost, and because it always underperforms, but only by a tiny little bit, people don't get swung around emotionally by periods of outperformance or underperformance. So we think there's, in a sense, what passive offers is very valuable. On the other hand, we don't think people have to own the average active manager. And if you look at the data, there are a few things that are clear. Characteristics like low fees and an alignment of interest tend to be correlated with outperformance. And that's what you see. I think Capital put out a study with Morningstar that showed that managers with those characteristics outperformed something like 85% of all rolling 10-year periods.
Okay, so you just end up having to look for the better active managers, and the rise of passive helps you do that. We can't not talk about the Presidian wrapper, the non-transparent active ETFs. You have not chosen to go down that road. What was behind your decision to go with the transparent route? Because a lot of people say there are drawbacks and issues to doing that. For instance, other people can front run you.
Yeah. Well, we have a culture of transparency at our place. We want our clients to know what we own. We have a low turnover approach. We invest in big companies, so the liquidity impact is really immeasurable. So in a sense, we feel that offering a real ETF with full transparency, we think that has advantages and is sort of a cleaner approach. On the other hand, what we'd say is we sort of welcome Presidian because it makes clear that there are also times when active management, even the average active managers, outperform cyclically. So we think that it's good to have in the ETF space active managers so that clients can begin preparing their portfolio for periods of time when maybe the S&P isn't on a one-way trajectory, and of course active tends to do far better in choppy markets rather than one-way markets. But we think that they have some higher costs, the lack of transparency. We didn't see a need to go that route. We felt we had the ability to offer a true ETF with true active management.
Well, let's talk about the ETF rule that came out this month, making it easier and cheaper to launch funds. One notable feature is allowing custom create and redeem baskets, which can be beneficial to the tax efficiency of newer issuers and active ETFs. Only 6% of all ETFs paid capital gains distribution last year versus 20%, almost 20% of active ETFs and 62% of active mutual funds. Will this new rule help you, and can you break down how it'll help you?
Yeah, I think it certainly will. It creates a level playing field. And so we think that's a fair, simpler mechanism. We like that, by the way, it doesn't apply to some of these gimmicky ETFs, these, highly levered, reverse, 3 times levered. There's a lot of danger in those areas. And, when you get a scandal or a problem in that area, it could, in effect, the perception of the whole space. So we like that there's sort of a differentiation happening between what are true sort of vanilla ETFs that can be captured under this framework and an equalizing of the playing field between active and passive. Because the ETF is just a structure. It can apply to all different types of management. It has advantages, it has disadvantages. So we like the idea that it levels the playing field and creates a place for active to be treated exactly the same when dealing with the same types of structures.
Also, nothing wrong with vanilla either. Chris Davis, Chairman and Portfolio Manager at Davis Advisors. Appreciate it. Thank you.
Thank you.
Now, coming up, as China holds its celebration this week, we dig into yin and yang of the ETF world. 2 ETFs that allow you to bet for or perhaps against the country's stock market. And for a drill down into all of Bloomberg's ETF content, check out bloomberg.com/markets/ETFs. This is ETF IQ. I'm Scarlet. This is ETF IQ. Now, for every ETF that offers exposure to an asset class or strategy, others are usually quick to follow suit. The reach for yield usually entails taking on more risk. Index IQ has a fund targeting junk bonds with reduced credit risk. Kelly Yeh is the firm's director of research. But first, Eric Balchunas is going to give us the drill down into the Index IQ fund.
Thank you, Scarlet. HYLV, it's high yield, low vol. Almost like an oxymoron or Diet Coke of high yield bonds, right? So it's aiming to basically capture the least risky, credit risk rather, area of the high yield market, right? So kind of logical. Low vol is popular in equities, why not bonds? 65 million, although a portion of that is from their own advisors. 40 basis points, about where JNK and HYG are. Let's look at the tail of the tape immediately because you want to see how this compares to HYG, which is the big dog of the area. And here's another one from Deutsche Bank that's also low beta. So you can see this one's a little more expensive and a little more volatile than the Deutsche Bank product, but both are way less volatile than the HYG you would hope. And look, this is the big thing. Double B, 74%, 77, 52. And so obviously you're also going to have a little bit of a lower yield. Let's look at the performance, not this year, they're all about 10%, but in Q4, because you think this thing should buffer, and it does. Luckily, you can see here that it lost 2.8% in Q4 when HYG was lost 4.4%, so you saved half. So Scarlett, I think that's when this thing's going to shine, is when there's a sell-off and people are looking for something with a buffer.
Yeah, it did its job then. Still with me is Kelly Yeh of Index IQ. Kelly, isn't the point of high yield, though, to take on more risk and therefore get more yield? Because this ETF goes against that idea.
Scarlet, we are in a low yield, high volatility environment right now, and investors are really looking for tools to generate income but also manage the risk on the downside. So in 2017, Index IQ came up with this high yield, low volatility ETF product, really trying to give investors a systematic way of investing in lower risk high yield bond. And the way we do that is leverage market-based information such as spread and duration. We have research show that a market-based metric is more responsive for the credit quality changes in bonds and usually lead rating agency actions by 20 to 30 months.
Now, we talked about passive aggressive and this shift to passive, Eric, and our colleague Nir Kaysar, who's a Bloomberg opinion columnist, recently wrote a column about how fixed income funds have been spared the shift to passive so far, but that's going to change. He says the industry has persuaded people they need an active manager to navigate bond markets, many of which are less liquid and more opaque than stock markets and less well understood by ordinary investors. And star managers still burn brightly in the bond world. Those selling points will soon evaporate, however.
Yes, so bond managers, in my opinion, have been very lucky to play against the AG, which I equate to the Washington Generals, the team that plays the Harlem Globetrotters, whereas the S&P is like the Chicago Bulls, right, in the 90s. It's full momentum. When will this change? You have products that are better and better, doing better things in the ag. When will they be benchmarked against these better ETFs and indexes that are being designed?
Good question, Eric. So when we think about smart beta or rules-based fixed income, we really think they are a way of active management by systemizing some of the best practices from active managers into rules-based format, and the benefit is removing some of the behavior biases. In that sense, fixed income and equities are really similar. But what's different from equities is they have been there for a long time, and investors have done a lot of education and research support. But furthermore, they have tools to allow them to really separate manager skills with access to systematic risk factors. I think fixed income, we're in the first inning, but we are seeing all those products coming out, which is really helping investors understand the drivers of fixed income return. And in the future, active managers will have a harder time to explain their return to investors.
So maybe playing a bit of catch up there. Let's shift to the alternative category, because you guys have the two biggest alt ETFs U.S., but they switched places recently. M&A is now number one with $880 million in assets, surpassing QAI. Why the bump up here? What exactly does M&A do?
Well, first of all, we're happy to not just have one, but two leading alternative ETFs
Bit of a shameless
on the market.
plug, but go ahead.
So QAI and M&A are doing different things. QAI is trying to target replication of the broad hedge fund benchmarks, where M&A is trying to give investors a systematic way of buying announced deals and try to capture the deal premium. For M&A, because of its low risk and high Sharpe profile, investors are not only looking for replacing some of the merger acquisition managers, but also looking at a way of using it as a fixed income alternative or using it as part of the equity allocation to de-risk.
And just real quick, how much potential is there here? You would think democratizing hedge funds would be a bigger hit. Only $3 billion. What's in the way?
So we actually have just done a research with Greenwich Associates, and the research shows for institutional allocation to alternatives, there's about close to $1 trillion allocation to liquid alternative products, out of which only $50 billion is in ETFs. And they forecast tremendous growth in the next few years. And the reason, as I mentioned before, like fixed income smart beta products, investors need more education to that product. But furthermore, this is a market environment where people will see more volatility, and this is where alternative products will shine.
Kelly Yeh of Index IQ, thank you so much.
Thank you.
Now, the ETF industry has something for everyone. And with China's ruling party turning 70 years old, we highlight a pair of funds tailored for both the optimist and pessimist. They are the yin and yang of the ETF world. The Direction Daily FTSE China Bear and Bull 3 times shares. The China Bull ETF trades under the ticker Yin, while its mirror pair is the China Bear ETF, better known as Yang. Both are tied to the performance of the FTSE China 50 index, which tracks the 50 largest Chinese stocks listed in Hong Kong. Both funds are also leveraged, offering exposure that is 3 times the underlying benchmark. Yin looks for triple the daily return of the FTSE China 50, while Yang seeks the opposite, aiming for triple the inverse of the performance. Leveraged ETFs reset their leverage daily, which can cause the returns to decay over the long term. As a result, they are better short-term trading tools than buy and hold investments. Yin has roughly $330 million in assets, while Yang has around $80 million. Each has an expense ratio of 95 basis points, in line with other leveraged ETFs. Bloomberg Intelligence gives the pair red lights in its traffic light system due to their heavy leverage, risk of losing money quickly, and the complications of volatility drag hurting their performance. Now, these two funds actually get quite a bit of volume, don't they?
Yeah, because when you go to single country, that's what attracts the traders. I mean, they're not going to do double leverage emerging markets, but when you get single country, a lot of volatility, and so that's why these products are popular.
And you got to love the tickers, Yin and Yang.
Perfect.
That does it for Bloomberg ETF IQ. Be sure to catch us each Wednesday at 1 p.m. New York time, 6 p.m. in London. This is Bloomberg.